for staying up for us. Vikas, 6,000 plus crores buy figure yesterday. I'm sure you were a buyer, though you've already been a buyer all throughout.
Hi, good morning. It's wonderful to be back. Actually, it depends on the sector. In some areas, we were taking some profits. Defense was one of them. And we were adding to some of our other holdings, some in hospitals, healthcare broadly defined. Sanjeev mentioned a good point about IT services. There's not been a broad-based recovery in earnings in that sector yet, but I think investors are making a mistake by overlooking that sector. So there's a lot to talk about, but generally we didn't trade too much yesterday. What I will share is last week when we were making our contingency plans, as you know, we think probabilistically, Deepika and I were spending more time thinking, if there is a sell-off, what do we buy? Rather than if there's a sell-off, what do we sell? How do we become more defensive? I think there's a lot of opportunity. Nikunj said all the right things, that rather than focus on the next 2 to 3 days, our focus is on the next 2, 3 years and beyond. And there's a lot to like still about this market.
You know, Vikas, much unlike the popular names with the FIIs, the Reliances and the Infosys of the world, you and your portfolios have been focusing on SMIDs, right? So would that focus continue, or would you say it's going to be a more balanced approach now? A little bit of underperforming large caps, but large focus on the small and mid caps as well?
We have increased our focus and our capital allocation on the SMID names, on the small and mid cap names. When we were in the studio in February, the question came up, is this the year for large caps? Our view is that in India, it's always the year for small and mid cap names. Since then, we have increased our holdings in small and mid cap names across sectors. Make in India beneficiaries dominate that list, but there are a lot of other themes that are being expressed, or a lot of other views that are being expressed in our small and mid cap names, and that will continue. We're increasing that. There was some thought that with the perhaps uncertainty around the election outcome or the volatility that might ensue, let's not go overboard in that area. But with that behind us now, the allocation of small and mid-cap names will increase over the next few quarters.
Right, and you know, one would imagine that at a time like this morning, Vikas, that we would be looking at very capex-related themes, especially in light of what we're seeing play out with respect to what the election verdict could potentially be. Would that be a prudent portfolio strategy?
We think so on our time horizon, yes. Yesterday, if you look at the capex beneficiaries, the direction of the moves was not very surprising. I think the magnitude of the moves was surprising to us, even though we're exposed to it already. The power beneficiaries, that and private capex beneficiaries, they moved more than we had thought. And you're showing one on the screen now that that was a strong mover yesterday. And in the long term, that should continue.
Right. But in the long haul, Vikas, you've always been a fan of the Make in India themes, right? I mean, the budget will also be the next event, and it'll come and go, and it will delve, I guess, more into the government policies, Make in India, PLI schemes, etc. Many of them have already been beneficiaries. And I guess you believe that in the long haul, that's the one theme that's here to stay and is going to make money.
That is a very real theme. It's still very early for many of these companies. Last week, I spoke to the CEO, the founder of a machine tool company in India. And if you look just in the last few years, the orders and the revenues for the industry from Japanese companies versus Indian companies has flipped. From 30% India, 70% abroad, it has now become 70-30. That 70 is only going to grow in a market that is growing. And so these beneficiaries are going to benefit for a long time. That's just one example, but there are very many. What has positively surprised me over the last 2 to 3 trips to India this year is how real the Make in India theme is, how large it is, and how quickly it is moving. And as we talked about in February, it's not just China plus one, it's one plus India. Anybody who is looking to sell to India is looking to sell abroad, can use India as an export hub. So this is still very early. This is going to take a long time. It's going to play out over years and decades, not just a few months.
And Vikas, you know, when we're looking at the auto sector, a confluence of factors have really been putting this space in the spotlight, be it demand revival, the new launches, festive season, etc., the spending power as well. How are you looking at the entire space as a whole if we were to expand the horizon and look at the overall supply chain, the auto ancillaries, and the entire auto space as a whole?
So it's a good question. Over the last 18 months ago, we were quite overweight four-wheelers. If you look at our portfolio allocation to vehicles today, it's quite different. That overweight in four-wheelers has gone to underweight. We are now overweight CVs and two-wheelers, but then we've also taken a lot of capital from other sectors and from some of the four-wheeler exposure that we had and moved it into the ancillary companies. There's a lot of these based in Pune and Chennai and in Delhi. There's a lot of companies in that supply chain that are worth looking at. And again, just like with the other Make in India beneficiaries, it's still very early for these companies.
Because, I mean, as critical as it is to know where to park your money, it's also where not to spend time. And India has largely and always been a very stock-specific market. So where is it that you would say that, avoid looking at that space right now?
I think we're expressing that view through our underweights in staples, through our underweights in pharma. We have consolidated our holdings into fewer and fewer names in those two particular areas. And in IT, there is a broad set of opportunities for the long term, but on a 6 to 24-month view. As you know, companies or stocks follow earnings, and the earnings recovery, we just don't see it broadly in the IT services space. But one thing I will say, though, is coming back to how we're positioned in the short to intermediate term, one thing that has helped us this year is having no cash in the portfolio. We've been fully deployed. That has not changed. We feel that there's enough liquidity in the portfolio that if there were to be a big dislocation, we can move things around. But there are a lot of opportunities. And being underweight staples, being underweight pharma, being underweight most of the IT space makes sense to us because there's so many opportunities elsewhere.
Because the seat leads for 487 seats are already out, and out of that, NDA so far, and again, these are early indicators, these are just leads, it seems that NDA has already bagged 311 seats, whereas India is at 145, others at 33. A big event is out of the way now. Would this uncertainty now being behind us make you deploy more cash in the days to come?
Yes, I think what we're going to do now is, even though the cash is already deployed and the cash levels in our portfolio are zero, is move some capital around into some of the less defensive names, even more so than we had already. I think there are a lot of opportunities for both absolute performance and relative outperformance in this market. As we've spoken about before, there's a general view that a market like China is only for relative performance because it's so hard to find absolute performance. We don't have that view. And in India, there seems to be a view that it's a market for absolute performance, but relative performance is very difficult. But as an active manager, we see so many opportunities in India. 6,000 listed companies now, almost 2,000 with a market cap over $100 million. The most active IPO market in the world. This is one thing that we haven't touched on yet, but there will be many more IPOs in the next few months than we had seen in the past few months. We're spoiled for choice across sectors, and we'll be allocating more capital to IPOs as well.
Because I recall in our last interview, you had made that statement that India is no longer an emerging market. India has already emerged. So suffice to say that at least in our lifetimes, we're nowhere near a peak when it comes to equities. I mean, sure enough, 5 to 10% correction in any given bull market is a given. But you think that the index will be maybe double from here in the next decade?
This view for me is foundational. As you know, as global investors, we can spend our time anywhere. Why are we spending so much time in India? This is where the money is to be made. And especially if you're a local currency investor, and if you don't have to worry about translations into dollars, into sterling, into what has been a stronger currency elsewhere. And this is why you see the very strong bid and continued support from the domestic investor, whether it's institutions or retail investors. So yes, this view that there's no peak in the market in my career or in my lifetime. This is foundational to me. I do think that investors who are in the long term materially underweight India are making a mistake. This remains the best market in the world for long-term alpha generation, and this is why we have allocated so much time, capital, and resources to it. I'm very excited for the next few years in India, just as we have been. The last 20 years, in percentage terms, might not be matched because you're coming off a much larger base. We've gone from $500 billion in market cap to $5 trillion in 2 decades. That pace might not be matched, but in rupee terms and in dollar terms, the size of the gains will be exceeded.
All right, you're very excited, and we'll end it on that very positive note. Vikas, appreciate you taking the time out and joining in and walking us through your top themes.
If you like this video, then like, share and subscribe to ET Now.